So, what we're going to do is we'll launch off. We're going to have Dave will speak first, and then Wynne, and then Neil, and we'll finish with Mark. About 5 to 7 minutes each, and then, unless I feel that I need to force a question upon them at that stage, I'll open it up to you. And we'll try to finish fairly strictly at 6:30. So, if we could begin with Dave.
Well, thank you very much, ladies and gentlemen. I'm delighted to be here. We were asked to address 4 questions, and I'm going to briefly go over them. We've got about 5 odd minutes each to do this. And the first one was, are long-term savings in the UK adequate? And clearly the answer is no. We have the second lowest savings rate in the OECD after Portugal, well below 5% of GDP, well behind the Benelux and Scandinavian countries, and obviously this is completely inadequate for long-term pension provision in the UK. And then we were asked to address the question of what factors deter long-term savings. Well, I think we should recognise that savings is a habit, and we've lost that habit in this country. And I think we might need to wait for a generation living in poverty in old age before it teaches its grandchildren about the benefits of saving long-term in society. About 100 years ago, a mother would have, when sending out her 14-year-old son to look for a job, would have said, make sure that job's got a good pension. Today, when the mother sends out her 21-year-old graduate son to look for a job, he probably asks, what is a pension? And that shows you how different things have become over the last century. We now have a credit culture. Credit is too easy. There was a time when some forms of credit were quite sensible. The first type of credit we had was hire purchase, and this allowed people to have access to things like fridges and washing machines, and then save for those afterwards. But now we've got credit cards, and credit cards for even very, very young people. Means-tested benefits, we've heard a lot about that over the past couple of days, also act as a great deterrent to long-term savings. No point in savings if the state comes in and provides you with fairly good resources after retirement to keep you above the breadline. So let's go down to the reasons for this. And I think that one of the fundamental reasons is that the time dimension of people's lives is very poorly understood. People do not understand the time dimension of their own lives. They can understand why it's important to save, say, for a holiday, for 6 months' time, and so on and so forth. But they have a very poor understanding of the distant future. 3 years, 5 years, 20 years, 30 years. These are in the future. There's some time in the future, but there's very little understanding of what this means. And that leads us to the difference between what Richard Taylor and Cass Sunstein call the difference between econs and humans. Econs, and most of the people on this panel have an economics training. They're rational optimizers, life cycle financial planners. They can get on and optimize, make their own decisions for themselves. With not all of them. Not all of them, not all of them. With minimum intervention from the state. Unfortunately, most people aren't like that. Most of us are humans, and that's why behavioral economics, which deals with the cognitive and emotional factors that influence economic decision making, has become much more prominent, and Richard Taylor is now a consultant to the present government. So there are certain behavioural traits that we've got to take into account, and these barriers, these behavioural barriers, we will need to overcome if we're going to have long-term savings in the future. The first one is inertia. People might want to plan for retirement, but they never bother to join the pension plan. We used to have, in this country, you were automatically a member of your pension plan when you became an employee, unless you actively contracted out. And then in the 1980s that changed, and you had to actively join the pension plan. And that led to the difference between 80% of workers joining the pension plan before this change to 20 to 30% joining after the change. After inertia, we have a lack of willpower and self-control. You might even join the pension plan. You might even wish to stay in the pension plan. But there's always a good reason to stop. You might want to save for a foreign holiday. You might want to go on a foreign holiday, and you temporarily stop saving for your pension, but you never get back to rejoining the pension plan again. Other characteristics of human behaviour are aversion to planning, particularly long-term planning. Another thing we do is we overestimate the probability of low probability events, such as early death after retirement. So people actually think they're not going to live very long after they retire, when in fact they can live 25 or 30 years after they retire. And they, as a correspondent, they overestimate the probability of low probability events. They underestimate the issue of not saving enough and then running out of resources when they're at high ages. Another feature, behavioural trait, is they overvalue the present and undervalue the future, so that they overconsume today and so face the problem of running out of retirement assets before they die. Now there are ways around that. Taylor's and Sunstein's book is called Nudge, and nudges are one of the kind of behavioural tricks that we can get to get people to save more. That's if we're not going to use compulsion. Everyone says, well, let's educate people better. Financial education will not work. David Laibson, one of the behavioural economists at Harvard University, says education is no substitute for a good default. So designing good defaults in pension plans, both in the accumulation phase and in the decumulation phase, are an essential feature of getting our savings model to work. And that's clearly what Nest is trying to do with its default investment programs and so on. Now, the rational economist, the rational econ, can decide how much to invest in their own education and how much to pay for advice. They can optimize that trade-off, but behavioralists, humans are not able to do that. So my aspect of this is looking at the behavioral dimension to decision making. And then finally, very briefly, there were two more questions. Is there a need for changes to the pensions rules? Well, retirement legislation and regulation needs to reflect the behavioural patterns that I was talking about and the limitations of consumers, rather than the false idea that really we're all rational consumers, rational economic agents, and as long as the state isn't there to muddy the waters, we can get on with this ourselves. And then the final issue was, is there a need for changes to taxes to incentivise long-term savings? Well, for econs, the tax incentives are perfectly adequate. We know that people who are econs, they maximise the amount that they save for their pension to maximise the tax gains. But for humans, tax incentives won't work. You can have cases where you have non-contributory pension plans in which the employee simply has to sign a piece of paper to get a free contribution from their employer, and 80% of the people don't even do that. They don't even get the free lunch. Now, economists say there's no free lunch. Here's an example of a free lunch, and here's an example of where humans simply don't take the free lunch when it's offered to them. So these are the issues that I think are important. I think the government should take these into account when it thinks about long-term savings. Thank you.
Okay, thank you very much. So we'll move on to Sir William Bischoff.
Thanks very much, Andrew. I too am delighted, obviously, to be here. Birmingham actually happens, without wanting to give you history lessons, happens to be the birthplace of Lloyds Bank. It was started in 1765 as a private bank of Taylor's and Lloyds, and it wasn't, of course, started with the benefit of having had savings. It was basically started by two people who were in industry and who made some money, and in fact then used the savings of other citizens and the people around them to create a bank. And for 100 years it had only one branch, and that was in Birmingham. Head office and branch were exactly the same. And the interesting thing is, when one talks about savings, Birmingham, of course, was considered, certainly for Lloyds it was, a major centre of collecting savings, and people, in fact, had faith in banks and gave banks. And in fact, it took another 100 years before, 1865, before it was felt that it should become a publicly owned company and have access to outside funds and the reputation that went with it. So I think Birmingham is very important for, and has been very important for Lloyds Banking Group, and continues to be important. The savings culture in the United Kingdom, as you've just mentioned, I think is obviously an important policy area, because savings are important for banks, they're important for investment through the banks, and they're important for investment through other means, equities and so on. That's important for individuals themselves, as well as for the economic growth of the country. I think you've just mentioned that the household savings rate in the United Kingdom has been too low, and undoubtedly it has been low. It's despite a concerted spell of deleveraging by UK households, the UK remains in the lower half of the league in terms of the proportion of income saved by households. Great. A recent discussion paper by Oxford Economics, commissioned by Scottish widows, shows that the UK household savings ratio is about 7%, compared with 11.3% for Germany, 14% for France, 33.5% for China, in the 20s for Japan, and in the USA the figure is 5.9%, but coming down again. There's a very good booklet in front of you, which I think you might wish to have a look at, which really gives an excellent history, in my view. It's a promotional material, but I mean, it really it really is quite good. I would commend it to you. Take it home to your sons and daughters to get them into the savings habit. But it really gives a history of savings, the deposits, and also the fact that savings have actually, over the period, been marginally inflation-proof, i.e. though there has been a real return over a number of decades, not the most recent one, in terms of returns on savings. What is the reason for low savings in the United Kingdom? A number of possible explanations. Easy access to credit. We haven't had to save, and therefore partly because we've had easier access to credit. Demographic trends, the reliance on the welfare state, which you have mentioned, and quite possibly culture. The Anglo-Saxon credit model versus the European savings model. And I would also say it must have something to do with the fact that a lot of the savings in the UK are held by proxy in the form of admittedly illiquid owner-occupied housing, where a lot of, because we're a nation that likes to invest in housing. The picture is not all gloomy. Research published last week by Lloyds TSB shows that household assets, which is deposits, life insurance, pensions and stocks and shares, not housing, grew by about 800 billion in the last decade, 800 billion pounds. And the majority of that was not equities, it was in fact savings deposits. And that's over £30,000 per household on average. That's obviously not evenly spread, but it's still a very large amount of savings. Household savings was negative in 2008 for the first time in the 1950s, and is only slowly recovering, as I said, back up to the rate of 7%. Confidence in savings. Obviously, people will only save if they feel confident. Earlier this summer, Mark Hoban, perhaps he is a nudger, but I mean, he said we want to nudge people in the direction of healthy financial behavior. I think you're right. We need to make sure that there are products available that they understand and trust. And I think this is where simplicity comes in. I think it's very important. Transparency and simplicity is hugely important. In this country, there are 20% of the population does not, in fact, know to do percentages, which is a very high percentage, and 80% wouldn't actually know what an APR is, APR percentage. And I think this is rather worrying. But it does show that you must, in order to have the trust of the savers, you must have relatively simple, or at least simple to explain, products which also the banks or the savings vendors can explain. We propose to act on it. Only a couple of weeks ago, Halifax, which is part of the Lloyds Bank Group, which in fact produced this little book, launched a new cash ISA savings account at a rate of 2.8%. Now 2.8%, I think to somebody like myself who's been in the business for 45 years is a very low rate, but it is, in relation to what in fact of course is available in the market, is a relatively high rate. and the opportunity this account has to, in fact, transfer the amount from previous years. The interesting thing about it, and it may astonish you, is that up to very recently, your ISA money would only earn interest from the time that your other ISA provider, in fact, or saver would in fact transfer the money. Now what we are actually saying is that as soon as you've handed in the documents, you get the interest rate from us. So this is relatively simple. It's simple, transparent, competitive, and as flexible as possible, which is in fact the Financial Secretary's admonition. What do I think that government should do next? It's government actually not by itself, but with the industry. I think this has to be a joint effort. A preference of jam today over jam tomorrow is a natural sentiment which we all have, and therefore improved incentives to long-term savings are much more likely to be required, in my view, in our view, to extend the rise in the savings ratio. And government and the industry have a joint responsibility in this important area. As far as the industry is concerned, that means product innovation on the one hand, the tailoring of the products to meet customer needs. I don't sell somebody who really wants a simple product, a complicated, complex product, because he probably won't buy it, and that are easy to understand. And products should do what they're advertised and without any hidden snags. What, on the other hand, is the role of government? Clearly, government has to set in place a stable and flexible regulatory environment to ensure that the industry has a confidence, A, to continue innovating, but also that the consumer's interests are safeguarded. Hugely important, that last point. But there are a number of policy areas that might play a part in driving up the household savings ratio. For example, are people put off from saving for the long term by the way that pensions are currently structured? Can we develop more integrated products that encourage people to save in a lifetime vehicle that is flexible and accessible in its early years before being transformed into a pension as people get to retirement, i.e. something which is flexible, you save and then it gets into a pension somehow or other, and perhaps has some of the tax benefits which have just been mentioned. I think this government has already shown that it is willing to look at issues differently, and I think that's very very interesting. For example, annuity rates are likely to be reformed, and we think that this could have actually a positive impact for retirement. And ultimately, although it's immensely complex, and I've had to, my colleagues have tried to explain it to me, and I can't, in fact, understand it. That means that if you ask a question on it, I'll turn to them. Can we consider the area of means testing, where the current system really does appear actively to discourage some people to save for the long term? Obviously, you've mentioned that, but I mean, there are all kinds of knock-on effects as to how you might go about it. No quick solutions, we believe, to this complicated policy area, but in the words of the Chancellor, we're all in this together, and we have to work together. The industry faces challenges on product innovation, simplicity, and protecting customers, while the government faces significant challenges of an aging population and, of course, a high public deficit. As I said, we believe in a joint government-industry effort where decisions are made for the long term rather than for the short term or for short-term financial and political pressures.
Well, thank you very much, Sir Wynne, and thank you to Lloyds Bank Group for sponsoring the event. So I'll now turn
Good, that's nice of you to say that.
I'll now turn to Neil Record.
Oh, thank you very much. I'm going to depress you because I'm going to concentrate in this 5 minutes on pensions and pension savings and ask a simple question with a very uncomfortable answer. The question is, if you want a really good pension, and I turn to my left and say that the really good pensions are now largely in the public sector, and that means a certainty of outcome, very roughly about 2/3 of your final year's pay as your pension, index-linked, a spouse's half pension, and lots of other bits and pieces. How much does that cost? Well, you might say, well, that's quite a complicated question because it depends on your investment returns. I say, no, we've just established you want certainty. And we can answer that question today very easily because we have, at least at the moment, a security you can invest in called an index-linked gilt, which will give you that level of investment certainty, but you won't like the answer. Because very roughly speaking, you'll have to, I'm assuming you're the sort of archetypical average worker. You're in the middle of your career and you're putting money aside for about 20 years. So the average duration of a pension fund is about 20 years. The interest rate you'll get over and above inflation if you invest in certainty is about 0.5% per annum today. And I've done some uncomfortable calculations, one or two other people have as well, so they're not just mine, it depends who you are, but if you're not a high flyer, just an average earner, you'll probably have to put away about 40% of your pay each year for 40 years to get a pension like that. 40% of your pay each year for 40 years to get about 2/3 of your last salary index linked. And you'll say that's totally unaffordable. It may be, but it's what a lot of people are currently receiving. So moving away from that, say, well, I can't afford that, it's too expensive, it's too gold-plated. What do people in practice do when they don't have the guarantee of either a private or a state, what's called defined benefit? They will typically invest in risky assets. So what I said, the first thing is, what does it cost to get certainty, i.e. to get the sort of pension that you get in the public sector, you used to get in the private sector on defined benefit. So if you accept uncertainty, how much does it cost? Well, with uncertainty, you can invest in theory, higher returning assets. I say in theory because in the last nearly 20 years, you've not made any extra money over investing in index-linked gilt versus investing in equities. But in the longer term, the very longer term, apart from being all dead, you will expect to get probably another 3% real return over and above the core return you'll get from an index-linked gilt if you accept investment risk. So accepting investment risk, and by the way, that makes a huge difference to your cost. So if you are, as an individual, prepared to accept investment risk, which means that you may have way less than the 2/3 of final salary that you were planning to have, you can probably put in 20% of pay per year for each of the 40 years you work. So that's still way more than most people are putting in. I mean, and if you ask a public sector worker or most private sector workers in a DB scheme, how much is your pension? They say, well, I put in 6% a year or 10% a year. And indeed, a lot of the default schemes which are now being talked about are 2, 3, 4, 5, 6%, you know, those sort of numbers. And they are wildly inadequate to get you a good pension. So if we're moving to a world where you're not having serious employer subsidies, we're moving to a world where, in my opinion, either we radically change our attitude towards investing in pensions, or we're all going to be extremely poor in retirement. Just a couple more points. Really a couple of questions. I've observed the behaviour, this is really a behavioural question, like David, observe the behaviour of ordinary people, not, what do you call them, icons, not economists or mathematicians or actuaries. Humans, that's the word. Over long periods of time. And I observe two things. One, I don't think that humans are equipped, psychologically or indeed intellectually, to make intertemporal decisions over 40 years. I think deferring consumption for a week is quite tricky. For a year, you know, well, I mean, you know, you laugh, but on a Friday night in a working class home 50 years ago, you spent, you know, a third of your weekly wage that night because you didn't want to wait a week and you wanted to go to the pub. A year is difficult. I think we're programmed to look after our children, so we understand that. But when our own retirement, you know, and I've got a degree in economics, a higher degree in economics, and I was totally uninterested in pensions when I was 20, and I think that is a major problem for voluntary contributions in pensions, and also for the risk-taking, the decision-making about taking risks or not in investment. Which brings me to my final point, that although I'm a market economist and I'm the scourge of the unions who think I'm trying to get rid of their gold-plated pensions, my own view is we do need an element of paternalism in pensions. because I think that it is unacceptable to allow, when it's too late, large proportion of the population to end up in poverty. And I think the alternative is that the government picks up the tab, as it is doing at the moment, and we've got ourselves in this very uncomfortable, awkward position where we have means-tested benefits at the bottom, and that's extremely ineffective at providing incentives for pension savings. So with that, I'll hand back to Andrew.
Thank you very much. Some grim food for thought there. And finally, Mark Hoban.
Thank you very much. And yes, it was grim food for thought from Neil, but he and David, I think, highlighted some of the real barriers to saving and some of the challenges that we need to overcome if we're to get people to provide more for their future, but also to provide for a rainy day. It's interesting, some stats about how much people had by way of savings prior to the economic crisis, and more than a quarter of households had no savings at all. That's so not even money aside for needs that might arise the next day, no money aside for their pension either, and about half of households had less than £1,500 in savings. So there's a real challenge here to get people to save not just for their long-term needs, but also their short-term needs as well. And the behavioural sort of barriers to savings, I think, are very clear. And so I think we need to have a range of responses to trying to tackle those issues. And whilst as a coalition, all of our values is about responsibility and promoting responsibility, I think there's a limit to how far you can go in expecting people to act rationally as econs to protect their futures. That's why there has been cross-party support around auto-enrolment. So the default option of saving for your retirement is the one you start off in, which I think will help tackle some of these issues. But also I think that we need to work with the grain of how people live their lives today as well, and to recognise that pension income is unlikely to be the only source of income in retirement. We're going to phase out the default retirement age, which will help those who want to work beyond 65. A lot of people will either need to do that because they don't have sufficient savings, or will choose to do so because they're fit and healthy and that's what they want to do. We've also announced that we'll scrap compulsory annuitisation as well. That will give people more flexibility in their retirement to decide how to use their defined contribution pot, and which of their source of retirement income they want to use at a particular time. I think, how do we go beyond auto-enrolment to get people to think about saving more for their short and long-term needs? And I think it's clear that if we accept the principle that not everyone is an econ, and despite having an economics degree, I'm not sure I am one either, we need to make sure that people have the rights of advice and support to make those decisions about saving and the choices about saving, borrowing, saving for any day, saving for their long-term position. And that's why one of our commitments in our manifesto was to introduce an annual financial health check, which CFEB is going to launch for us. And the thinking behind that is to get people to identify what assets and liabilities they have, what sorts of pensions have they got already saved up for, what rainy day savings, what life insurance will they have, what debts do they have. And take that and think about what sort of needs they have in terms of their financial needs, and therefore what do we need to do to fill the gap, and to try to nudge them in the right direction to say, well, actually somebody in your position should be having some life insurance cover, should be saving for their pensions. And I think that will actually take people some way down the road. It will create, I think, more demand for savings. And I think it also is a reminder that actually, in terms of creating demand for savings, tax incentives of themselves aren't enough to get people to save more. But there is a problem, I think, when you get to the point of actually someone wanting to save more for their retirement, wanting to save more for any day, wanting to take out some protection, say for life insurance or for critical illness, because actually the choice of products that are available in the marketplace are bewildering. I mean, there's huge discrepancy and variation between products. Now, rationally, as a good free market conservative, I like the idea of choice and competition between products, but actually people need to be able to decide what it is they're going to buy. They need to be able to compare from product to product. There are some areas in the insurance market where that works very well at the moment. If you want to buy car insurance, you know what it is you're buying. You can go on online websites, you can compare prices, you can compare some of the twiddly bits about excesses and whether you get a car when your car's been repaired, etc. that actually, to my mind, sends some very clear signals about the sort of market we should be trying to develop in financial services. It goes to Wynn's point about products that people understand. They do what they're supposed to do. That doesn't necessarily mean the products themselves that underlie those concepts are simple or straightforward. There may be some technical things that perhaps achieve a degree of certainty. But people who are buying these products need to know that they will do what it says on the tin. And I think for many people in financial services, or to the customers of financial services, what they bought doesn't quite do what they thought it would do. And so I think we do need to get the product range right, and to ensure there is competition, there is transparency, people are able to choose, and that the product providers are able to compete along lines of performance, about brand, and about the cost of those products. And that's why we're going to do some more work later this year in looking at simplifying products, learning some of the mistakes with stakeholder products, but trying to recognise if you get the demand side right, you need something right on the supply side that people can actually go out and choose. I also think we need to empower consumers much more to help them make the right sort of choices. And part of that is about the information that consumers use. There was one of the consumer organisations launched a super complaint about ISAs. Actually remarkable how many companies who offer ISAs didn't put the interest rate on their statements. We talked about the transfer of ISA products, ISA accounts between providers. Yeah. Sometimes we're taking 30 days, we're going to legislate to reduce that to 15 days to help speed up the marketplace. So there are other areas where we're keen to see much greater switching, much greater power for consumers to be able to compare between products, and I think that will help people get in the right direction. But I think there are a range of interventions that policymakers do need to make to encourage people to save more for a rainy day. But I'm very conscious that actually this is a partnership. It's not something the government or regulators can do by themselves. We need to work with the industry to get there. And we also need to make sure we actually meet consumer needs and actually trying to encourage them to save more for their future.
Okay, well, thank you very much to all our speakers for their contributions there. Before I open it up to others, I just want to press you all on one particular point. So, you all seem to take the view, in thundering unanimity, that there is inadequate saving in the UK, and that the question is what we should do about it. But I just want to play devil's advocate for a moment and press you as to how convincing that really is. Because, of course, what one's assuming in assuming that the pensions are inadequate is that people are going to retire at anything remotely close to what the retirement ages are now, or what have been retirement ages that were typical over the past decade. So is it not plausible, I put it to you, that actually people are expecting to retire much later in life? And secondly, it's a rather odd kind of claim that people haven't been saving enough, given how disastrously poor returns have been on pensions over the past decade. Might it not be that people are just that little bit more rational than you've actually been giving them credit for?
Perhaps I can try and answer both those questions. It's quite interesting to look at the history of Japan, to come to your second point, where in fact the Japanese citizens found, A, that they lived longer than they thought they would live, and secondly, that either the state scheme or the scheme provided by Mitsubishi or whoever it is that they were employed by was not likely to in fact pay out, not at anything like the rate that it was thought to pay out. And of course what the Japanese have done is to save, and I think when one looks at the growth of the Japanese economy, it's done terribly well on the export side, but internal consumption, because there's this vast swathe of people who are in fact saving more. In fact, a very eminent director of the Bank of England, a deputy governor, in fact, encouraged us, encouraged one of the things, don't save so much, in fact, which is the opposite side of the thing, don't save, consume. I think on retirement, though, I don't think it will happen quickly enough to really make an inroad into what you said. We all know that when Bismarck introduced the pension schemes for the Prussian civil service, he had it initially at 55 and then at 60, the average longevity of a male, and because it was males in those days, was less than 60. Yes, there were a few people who were over 60, but it didn't cost anything. Now, a male born in London who reaches the age of 65, why do they choose male born in London? Because males are not usually very good at looking after their health, and London is not necessarily the best climate. A male born in London who reaches the age of 65 has got an average life expectancy for another 24 years. So even if you've got the males born in London who have 65 another 5 years, they'd still, in fact, live for another 19 years. This is a very, very heavy burden to bear. So I think you won't just the fact that people are, in fact, going to retire later simply does not yet eat very much into the longevity, in the extraordinary increase in longevity.
Okay, well, just at the risk of hogging the mic, I shall just put in one little stat for you on
Yes,
that,
please.
which is that the Turner Review of pensions in 2006 concluded that the level of savings at the time implied that people would raise their retirement ages in order to be compatible with that from about 63 to about 68, which he deemed to be, on average, which he deemed to be very implausible. And I just submit that in the late 1940s, the average retirement age was about 68. So how implausible that really is an interesting question. But maybe I'll just maybe I'll open it up, as I say, rather than hogging the mic. So we'll try the gentleman there.
Jasper Barron's, JP Morgan Asset Management. When you're absolutely right about simplifying the system, tax incentives, policy simplification, rationalisation, etc. Mark, you're right also there's a lot the government can do, but please can we make it clear to you that once you make these changes, stick to them. It's the biggest problem, I think, in government is the constant change. The second point, and David is right, it's about apathy and inertia. How do you get people, young people, to get into this early? I think what you have to do, and I'm going to make a lot of people I'm going to make this very unpopular with a lot of people here, is maybe one of the things, Mark, you could think about doing, and after the Panorama programme last night, people had momentum, is increase the tax take fractionally that you get from financial service companies, maybe even by as little as 0.25%, and put that into a national campaign to get people to start saving. Some of the biggest social changes that we've seen, and that can be matched by the government, some of the biggest social changes that we've seen over the last couple of generations have come from that. Drink driving, seat belts, smoking, drinking, 5 fruit and veg a day, don't die of ignorance, some legislative, some not legislative.
Okay, well, I think we've got the point on that. Okay, so the urging there is that it's important that government sticks to changes, and secondly, there's a proposal that we should have a modest tax take from the financial services industry to have an information campaign. Well, do you think that would be a good solution?
Well, I certainly think that if you provide in school basic information about life cycle financial planning, what a pension is, what a mortgage is, and so on, that will have some help in getting everyone to understand up to a certain level. But I think beyond that, education is not going to work. And I rather like Neil's idea, which is Dick Taylor's idea of this kind of libertarian paternalistic approach, whereby people are automatically enrolled into savings programs, possibly in school, where we used to have savings clubs and so on in school. I've got two nieces in Australia, and they have savings boxes. There are 4 items in the savings box. One is for immediate consumption, one is for a little present for mum, and another one is for longer term savings. And you've got to get that habit when children are young. But if they don't save, then voluntarily, then I think we have to have some form of libertarian paternalistic approach to this.
Are you going to stick to the changes then?
Well, I recognise Jasper's point actually. We saw that in previous governments that there were regular changes in pensions policy, which actually undermine confidence in long-term saving. And I think the extent to which you can have a predictable and stable regime that supports saving, that's important. But I'm also very conscious of the cost of tax incentives. So I think we need to make sure we've got a broader range of incentives that encourage people to save. That's not just reliant upon expensive tax relief. Part of that's about products and about flexibility, but also about the demand side. Now, you asked about industry-funded campaign for savings. The industry is already going to fund the Consumer Finance Education body, which will, one of its focus is to encourage people to save more, equip people with the tools and information to help them plan their finances better. So you know, that supplements some of the stuff the industry's already doing.
Okay, well, let's try a couple more questions. So, gentleman back there waving his order paper. It's enthusiastic.
Two questions. One was the gentleman from the bank who seemed to say in his presentation that easy access to credit may be one of the reasons for low level of savings. I mean, people have only had easy access to credit because lenders have been willing to give it, and we seem to swing from easy access to credit to no access at all. What might lenders do differently to change the habits of people? And the second is a point on pensions. Why should anybody my age plough significant sums into pensions when people 30 years older than us, who we've seen retire recently, have seen their returns significantly lower than would otherwise have been the case that they were expecting? What might Mark suggest that the government additionally can do to change that?
Okay, we'll try another one. So we'll try lady here.
Given the current demographic pyramid and the huge unfunded public sector pension deficit, and the percentage of current pensioners needing additional financial help, do you think that in 30 years' time, when I hope to retire, there will be a state pension for someone who has managed to save adequately for their retirement? In other words, will the state pension ever actually be means tested?
Okay, so we have...
Sorry, you won't be able to retire in 30 years' time.
Silver tongue, yes. Quite right, yes.
Add another 20 years to that.
So two things then. I suppose first one was wasn't it, as it were, it's all very well for the banks to complain that it's too easy credit, but it's the banks that provide the credit. Why should, I suppose, two questions about why might anyone plough their money into a pension. So one concern is that returns are pretty bad now, and the other concern is that the consequence might be that they get a state pension means tested. Why don't we start with Neil on this?
I'm not sure I've got much, as not a government minister, I'm not sure I have much to comment, except probably on the latter question about why should I save now as a young man when my returns have been very low. I think there tends to be and I think you picked this up, Andrew, a negative correlation between the amount you are forced to put aside and the returns you're going to get. So if you need to have money when you retire, however painful it is with low or indeed negative real returns, you have to put money aside. If you don't, you'll starve, or the equivalent, you'll be on the basic state pension. And I think it is which is close to starving. It is the very low real and nominal returns that were obtainable in Japan over the last 30 years that meant they had high savings ratios, because it was the only way to have enough money on which they could live. So it perversely, I mean, this is one of the things that actually quite interesting about current monetary policy. Perversely, as it happens at the moment, we've decided we are savers for the first time for a long time. I suspect actually it's paying down debt, but that's correlated at the moment with negative real rates of return. So the conventional sort of upward sloping supply curves and downward sloping demand curves don't appear to be working in the short term and probably aren't working in the long term either.
And I think there's another issue, and that's the volatility of returns over the last 20 years has had a very negative impact on accumulation. And whether we're going to whether the future is going to be one of very volatile returns. We've had 2 stock market crashes in the last 10 years or so. Property is not behaving in the way it used to. So, and I think with the rise of countries like China and the effect that they will have on financial asset returns, the future could be very different from the past in terms of returns and volatility.
Anybody care to guarantee that there will be no further means testing of benefits, such as perhaps the state pension? Answer came there, none. So let's try somebody else. How about this gentleman?
Yes, hello, Richard Jackout from Dulwich, West North constituency, just a Conservative Party member. My comment will be to the entire panel, and it will be tripartite, so please, if you have time, respond. If not, we won't hold it against you, obviously. So, effectively, David talked about education not being enough, because one Harvard academic says it must be true. At the end of the day, we have to face facts. Yes, you're right, if you instill children and young people with the knowledge of the word Pipsy, we're all aware of Pipsy, then the incidence rate of savings, pensions, investments, alternative investments for the future to pensions will go up. Secondly, David, you touched upon, I don't mean to pick on David, but David did bring up this issue, touched upon people, and aren't they also responsible, they're only ordinary people, etc. Yes, they're ordinary people, however, they must take responsibility for themselves, but then we move back to why aren't they taking responsibility for themselves? Yes, Labour government's entitlement culture. Beyond that, they're the banks. Now, we won't demonise. They are a great financial institution. They help this nation in ways that other institutions cannot. But I will wrap up briefly. MasterCard, American Express, any bank, any lender has been totally irresponsible in the way it has pushed hire purchase in a post-Fordist economy.
Okay, thanks very much. I think we're clear on that one. And at the back there.
Really a point for Mark. It was very good to hear you talk about transparency and giving people choice, and the examples of the car insurance website are excellent ones. Is the government though planning to do something very specifically on the equivalent for annuity purchases, where still far too many people sleepwalk into very poor annuity rates and lose themselves thousands of pounds over the course of their retirement? Can you do more to get people to look into the market and get the best rate they possibly can?
Okay. I think we'll take one more. Gentleman there.
Phil Hall from Hall PR. I just wanted to gently change the point that David made about financial education not working. The evidence actually suggests that some of it does work, some of it doesn't. Very much depends on how it's delivered and what's delivered. Research from the University of Cornell, for example, the University of Cornell found that it did make a difference. Closer to home, the University of Manchester tracked about 3,000 students over a 3-year period who were taken an IFS School of Finance qualification in personal finance. And what they found is that the majority of those students changed their behaviour as a result of what they learned. One of those key things being that they should have additional savings products.
Okay, well, we'll note.
Did it last? I mean, was it a longitudinal study?
It was a longitudinal study, 22 months after they...
22 months? We need longer than 22 months.
After they'd taken the qualification, it's still showing those.
Okay, well, so I think we might note that point. So we had the other two questions was, so one was about, it's all very well for banks to complain that people are irresponsible in their savings decisions and not very well informed, but banks themselves are irresponsible in their lending decisions. Then there was a question about people, just you clarify that one again? It was about looking at
the point of annuitisation and the open market option.
Annuitisation, okay. So why don't we start, why doesn't Neil perhaps on the annuitisation?
You're right about annuitisation, that is part of education, but it also plays to my point that the sort of decisions that ordinary people, I hate to use that word, make are very difficult over those long periods of time. And when I say long periods of time, yes, you're right, just get the best annuity, but I would say the biggest problem is not so much that they're only getting 90% of the annuity value, but they almost all, 90+% of annuitants will buy a straight nominal annuity, not index linked, and in 25 years' time, they'll be on pension credit.
Mm-hmm. From the Secretary, do you think the banks have been irresponsible?
Well, I think that both lenders and borrowers need to take responsibility for this, and people have to make choices about savings and investment and about borrowing, and so I can't think you don't think you can just simply point the finger at the banks and say they are to blame for this, and that's why I think we do need to improve financial education. I agree with David, it's not the answer to the problem, it takes you part of the way there. That's why I think some of the insights from behavioural economics help you get to the next stage of the argument. But you do need to make sure people are making good quality decisions. They need to have transparent information. Sometimes we bombard people with too much financial information. If you look at the terms and conditions in your credit card, loans, pages and pages and pages, actually people don't read. But the answer is, well, we told you everything, and sometimes telling you everything doesn't.
It's far too much.
It adds opacity and clouds the key information. Just on the open market option, there's a very good issue about defaults there. The default at the moment is you stay with your pension provider, and you take out your annuity with them. There has been some work done to see if we can encourage more people to shop around. One of the strong arguments that's been put to me is actually the default should be to shop around, and that might get people to get higher rates or higher returns from their annuities, and it's something we're looking at the moment.
Hey, lady here.
Bella Matter from Sun Coalfield. In Germany, the employers play a really important role in helping the employees to save, and they put in a small contribution and they're also tax-free. So I would like to ask the panel about that, whether that's a potential area to look at in the UK. And the other area is when it comes to new products, I do recommend that the bank should test the products before they get rolled out on an old age pensioner and a student. And they should have those two extremes of people on a panel, as well as a regulator, before any new products are rolled out, because a lot of the products are, they can't be understood, and I think that would be the best way of going forward.
Okay, and try question there.
Isn't one of the major problems in the provision of, I'm Billy James, Kensington, Chelsea. It isn't one of the major problems with the provision of pensions, the behaviour of some of the providers. I was at, for example, the annual meeting or special meeting of Lloyds TSB when they agreed to take over ACOS and casually wrote off the savings of 800,000 or 90% of the savings of 800,000 people with no apology. Although they warned from the floor at the time it was going to be a disaster. But the argument made to me at the time was, don't worry, we'll get your money back because we'll be a monopoly with 30 million customers, and therefore we can charge more or less whatever we want. So isn't one of the keys to effective pension providing to ensure that initially no pension provider has more than 10% of the market, and that all pension providers have to publish their investment record in full?
And I'll take one more.
Rod Cartwright from Ketchum Cleon. Interesting, I've been to 2 meetings now on savings, which are focused almost exclusively on pensions, at a time when the government was just about to scrap the Child Trust Fund, which was a classic nudge that was likely to generate around £3 billion a year of assets for 18-year-olds from 2020. So my question is, why the government is planning to use parliamentary time to scrap the CTF, to then consult on a successor to fill the hole, to then use more parliamentary time to replace it, when they could just retain the wrapper that exists already without any or negligible cost to the taxpayer.
Okay, so we've got 3 questions there, so perhaps 4. So one was about whether we should have a greater role for employer-based contributions, and perhaps also the question of road testing a bit more of the products. It's a question of whether there should be more competition in the pension providing sector, and then whether, if one's so in favour of pre-enrolment and nudges of that sort, why do we want to abolish the Child Trust Fund? I might start with David on the question of, do you think there needs to be more competition?
Well, you've got a trade-off here between economies of scale and genuine competition. In the case of annuity markets, for example, the point about the open market option, the point about having that as a kind of default is all very well taken. But if then you then have Solvency II, this means that the huge amount of capital has to be devoted to this type of activity, and therefore you're going to get few providers of annuity products, which is going to limit competition. But then again, it might be the case that the natural size of the market is a market with only a few providers. But then how do you get competition when the natural size of the market is a small number of providers? That's the issue that we've got to face here.
Do you think that there's some tension between the idea of having lots of competition and the weaknesses of these poor humans who are unable to decide on what's in their own best interest?
Well, a lot of the competition is wasted because a lot of the fees, in the case of voluntary provision, about 1/3 of the fees go in initial marketing costs, which is simply, in a sense, some kind of wasteful competition between providers offering rather similar products. And but on the other hand, if you then have monopoly provision, you get inefficiencies built in. So there's this constant tension between economies of scale and efficiency.
So do you think that there should be more of a role for employers in making contribution?
Yes, I do. I actually think that the German system does work quite well. Actually, ours, of course, has worked up to now pretty well. It's just that the companies who are providing it, and I think the same will happen in Germany, incidentally, companies are prepared to pay, to take, I think, somewhat of an investment risk. I think companies are not prepared to take longevity risk. The longevity risk, which extends life from 60 to 89 or whatever it is, or 65. So I think companies should be involved as to how much they will actually expose their own balance sheet, particularly to defined benefit, I think is less likely.
Do you think that there's an argument that perhaps pension providers should target more of their marketing efforts at companies who might have some advantage in how well informed they are, so then their employees ended up being perhaps also enrolled, and that might be a better a better position from the point of view of consumer information?
I totally agree with that. I mean, I sit on the board of two American companies, very large companies, and they spend an enormous amount of time, their HR departments, in actually getting the employees to subscribe to these things. They're no longer defined benefits because they've gone away from their defined contribution. But I think with defined contribution, of course, in a way, the employer has got a greater moral obligation to make sure that the employee actually invests safely, because it's his choice any longer, and to provide, for example, a stable of investment managers that has been approved and so on. So I think there's a lot to be done in employer and employee actually working together, and the employer really does have a moral obligation there. Yeah.
And I suppose the Financial Secretary, it's mainly a question directed at you. Is there not some tension between the idea of trying to encourage more saving through nudges and then abolishing the Child Trust Fund as a nudge measure itself?
Well, I mean, the Child Trust Fund, we've decided to scrap because of the cost to the taxpayer. And we have to use parliamentary time to do that because we can't scrap it in any other way. So we've got to take a bill through Parliament to do that. But we recognise the importance of encouraging children to save from an earlier age, which is why we're consulting on a cheaper alternative to the Child Trust Fund. But what we need to do is to make sure people who do save for their children, or children who save, don't get to age of 18 and just blow it on a big party. We need to think about what it rolls into, and have we actually encouraged children to do a good savings pattern.
Okay, so we've got time for one more round of questions. So we'll start with the gentleman at the back in the yellow tie.
Thank you very much. John Butcher, former chairman of Lloyds Superannuation Fund. I don't know why that should cause a laugh, but anyway. I suspect that two of the principal barriers to investment in pool funds are, number one, the fact that investments can go up as well as down, which of course is a misnomer, because they either go up or they go down over any period of time. But the simple fact is that people do not want to risk in pool funds excessive diminution in value, and therefore there does need to be a better mechanism to protect that. Because after all, the investment managers can convert into cash or bonds to protect that to a certain extent. The other problem, which the professor rightly identified, is the enormous costs that are charged to the investors, whether it be pension funds or anything else, and that these, again, are excessive due to all sorts of factors that need to be limited. And if I could end by quoting Bismarck, as Sir William has mentioned Bismarck, it was Bismarck who said that the biggest problem facing Europe was the fact that the British and the Americans spoke the same language. I suspect that a lot of the problems of investment that we're now facing has come from America. And what's he doing about it?
Bismarck or?
Try, gentlemen.
Just for sales from Hackney. 2 points very quickly. First of all, I invested in the stock market long term. We do need to deal with the city sharks. Those directors who accept reckless takeovers, they'll rather make reckless takeovers. Those directors who accept cheap takeovers. And thirdly, the management buyout, where the directors are involved. We do need more control over the conflict of interest. That is, there have been a number of scandals over the years. Laws of libel prevent these actually mentioning.
So, well, perhaps we'll terminate that one then. But I think you made your, I think your point's clear, sir, about the about city sharks and takeovers.
For goodness sake, Gordon Brown raided the pension funds. Can't we put that back over 20 years? I want 20 years.
I'm Tony Johnson from Chico, and I followed all the advice that the panel had put forward. I was with Lloyds DSB as well. I only spent 20 odd years there, and I bought SAYE schemes, and the day I left, the shares were £10.50. The HBOS takeover was put through without disclosing the loan from the Bank of England. There has been no empathy expressed for the substantial losses that so many shareholders have incurred. And I would like Sir Wynne to actually, now he is in control, to actually change the whole ethos and to ensure that bonuses are brought to an end and not paid until such time as dividends recommence. It seems quite wrong that people should be paid bonuses when shareholders have lost so much money, particularly employees of the bank itself. And I would like to ask Mark Hoban to ensure that the talk of making excess profits from the sale of the shares in the bank cease. We've got into this situation because Gordon Brown took away the proper regulatory responsibilities and failed people like me and other shareholders. And I'd like to see some real change in empathy.
Okay, thank you very much. So we have questions there, and is it that we've partly are people deterred by the fact that their investments can go down as well as up, and do we need either to take away some of that motto or perhaps take away the fact a little and ensure that they can only ever go up? Is there are costs excessive? Are there too many city sharks? Still particularly reckless takeovers and conflicts of interest? And finally, should bonuses only be allowed to recommence in the banks owned by the government when dividends recommence? Perhaps I might just start with the last question with the Financial Secretary.
Well, I'm grateful that the bonus policy of the banks that we have a major shareholding is determined by management in conjunction with UKFI.
Why?
Because they're managed at arm's length from the Treasury.
You own it.
But Andrew, if we started to intervene in bonus policies, then we intervene in staff pay, in lending decisions. I think it's right for these, if we're going to return these banks to long-term health, they're managed at arm's length from the Treasury. And I think that's the right thing to do.
But how are other shareholders? Because you would contend that in other settings, shareholders should have had more control over the remuneration policies of banks in the meantime. So why isn't it that it's up to you as a major shareholder to control the remuneration policies of these banks now?
Well, UKFI deal with that as a representative government as a shareholder.
Okay. And
I may just refer to Christopher's comments there about, I take a rather old-fashioned view that actually shareholders are the owners of companies and they should be holding the boards to account the decisions that they take, because it's shareholders who approved major transactions. So that if shareholders believe that a company's being sold down the river in a takeover bid, then they should held out for more money.
I have a great sympathy with what you've just said, but I have to say, first of all, I wasn't there. I can apologise, but I wasn't there, so it doesn't really help very much at the time. I note the comments that you make in relation to dividends, and obviously we're not here to discuss the affairs of Lloyds, but I can assure you we are very keen, obviously, to, within the confines, obviously, of the capital resources that we have, to recommence dividends. I would say, and I think it's very important, that if shareholders had felt so strongly, as you obviously do, and as the gentleman down there felt, 95% of the shareholders did actually vote in favour of this particular transaction. I wasn't there, and I'm not going to say anything more about it. 95% of the shareholders by value. And I think one has to, if we have, in fact, shareholders who, in fact, as Mark has just said, have a role to play, then obviously management does listen, has to listen to shareholders. I listen to UKFI quite a bit, actually, and they've got 40%.
These were institutional shareholders.
I can't help that. I mean, we have, in fact, one...
Your argument's not correct.
Please, sir. We do actually, we have in this country still one share, one vote. And if you want to change that, speak to government. But that's what we have. There may be institutional shareholders, but it is one share, one vote in this country. If you want to change that to one person, irrespective, then I think it's a different matter.
So, David, if I might move on to you, do you think that it's possible that these statements about investments can go down as well as up make people think that the risk of them going down is too high through perhaps some of these the salience points associated with their bounded rationality, and perhaps one should adjust some of those slogans?
Well, this is another behavioural issue that people don't like. They don't like risk. But the fact is we live in a risky world, and people have to accept risk and risk-taking as part and parcel of any long-term financial plan. People want guaranteed returns, but guarantees are very expensive, especially long-term guarantees, and people are not prepared to pay the price of those guarantees either. But we live in a risky world, and we have to accept that, and people have to understand that, and there is no way around that.
And Andrew, if I could just to sort of re-emphasise the point, you can have investment return certainty, not longevity certainty, but you can have investment return certainty, yes. But it's very expensive. Your call, it's 40% of pay for certainty or 20% of pay and take a chance. Up to you.
Right, well, on that, on that robust note, which I would myself fully endorse, I'd like to thank our excellent panel for their generous giving of themselves.